I'd love to do this session interactively. So rather than me just bore you for the next 20 minutes, happy to take questions, be heckled through the presentation. Because what I want to talk about is the gold industry. I want to talk about evolution. But I want to leave you with some things to think about after this presentation. Because I've sat through a lot of the presentations. They've been really good. But there's been a lot of graphics, a lot of drill results, a lot of IP things. The next big thing is just around the corner. So there's a lot to absorb. But I just want you to try and step back for a minute and let's just go out for a few minutes and talk about the gold industry. I've described the opportunity for gold over the next while to be 5 Ds. And these are the 5 Ds that I've put down as to why I'm optimistic and positive about the gold price. There's rising debt defaults, debt is rising, decoupling between China and the West, destabilization, a war in Ukraine is ongoing, and decarbonization is a key thematic. I think these are all positive things for gold. Decarbonization is particularly positive for copper. At Evolution, you get the bonus of a 20% revenue stream of copper. But I want to focus on 3 of them today and just give you a perspective. This debt rising, because there is a real correlation between the amount of debt which the United States has and the gold price, and that's held true over 50 years. The reality is that for some reason the US government has spent way more money than it's actually earned. That's to the point where that debt clock, which is actually on Times Square, it's live, it's $32.2 trillion today. So that's what the US national debt is. And that means that every taxpayer in the United States today effectively owes $250,000 US each, without any real plan as to how that's going to be repaid back. That debt started at $40 billion just before World War II. It goes up by $100 million an hour at the moment. So when we did our Investor Day presentation about 8 or 10 weeks ago, it was $31.8 trillion. Now it's well over $32 trillion. So if you want to know where the gold price is going, I think the best indicator is US national debt, and US national debt is rising. You've got the Biden administration with what I've heard Robert Friedland call the Inflation Acceleration Act, not Reduction Act. I think it's pretty accurate. There is no end to this debt. I did a lot of work in China. Some of you may remember that I built Sino Gold, which was a company that developed mines in remote parts of China. We sold it in 2009. But this chart really does disturb me because it reflects the massive change that has happened in the relationship between Western democracies and China. It's difficult to talk about, it's sensitive, but it is a reality. In 2015, Australia and China signed the free trade agreement. And I don't know how many of you were at presentations and conferences then, but the mood was really positive, energized, globalization was the thematic, and that does seem to have been the high points of the relationship. This chart over here shows that in 2017, $300 billion was raised by outside of China to invest in China, and today that number is about $30 billion. So that's a 90% reduction, and I think it really reflects the change in relationship between China and Western democracies. It's unfortunate, but it is an inconvenient truth. There is an opportunity to get back on track, but at this stage you'd have to say that all indications are that it's going to get more divergent and more confrontational. It really surprises me to hear the Australian Defence Minister talk about getting on a war footing for China. It disturbs me that Japan and Germany are now actually remilitarizing. So the chance of a reversal and a step back, I think, is difficult but not impossible. But if you're looking for a catalyst for gold, I think this is definitely one of them. And that's really reflected in how central banks have been behaving. When globalization was on, central banks were exiting gold and were reducing their holdings and were net sellers. That's the green side of the chart until 2010. And then over the last decade, you've seen central banks, and it's not the US Fed, it's not the Australian government, it is other banks in more of the emerging markets, which are sometimes on the other side of that debate with Western democracies. And they've been big buyers of of gold, particularly in the last year, and that was definitely reflected, the catalyst was the Ukraine war. But you can see that massive buying by central banks, and that isn't reflected by institutional interest in it, but it will be as that buying continues, in my view. So I think those are the three things that are the likely catalysts for the gold price in the next 12 months, and why I'm most optimistic, I've been for a long time, about the gold price, less optimistic about the world, but optimistic about the gold price. Then just a quick one on copper. I know this is a gold conference, but you can see the demand for copper. There's $125 trillion that needs to be spent on getting to net zero by 2050. And you can see the number of discoveries on the chart. There are less and less globally significant copper discoveries being made. There is a lot of money being spent on trying to discover those. They may be deeper, they may be somewhere, but we're not finding them. So the likelihood is that the copper price is going to go higher in the next, sustainably going forward. Any questions on that? Here we go.
Like you, I worked in China in the early 80s.
You need a mic. You were before me if you worked there in the early 80s.
Yeah, I worked there in the early 80s with the Chinese government and so on. But how we go with China is really up to China. It's really up to China. She's arming, we're not. We're talking about it, but they're doing it. And they're aggressive. So how can we help? How can we help?
I agree with you. I mean, both sides have diverged. But we're in this dance now where both sides are moving further apart rather than closer together. And that's a dangerous shift over the last few years. I'm not painting the positive picture. I'm hoping for the positive outcome, but I'm not hopeful. So just can I go back on this? A very quick snapshot of evolution. I helped found this company in 2011. We started with no production and a few really tired and old assets, which were founded out of a merger with Newcrest and Catalpa and Conquest. I've been fortunate to work with an amazing team of people that's grown this into, I think, the third largest Australian listed gold company, a market cap of around 6.5. I think it's 6.7 today. 30 million ounces. I think this is important. 30 million ounces of resource, 1.8 million tons of copper resources, and reserves, really importantly, 11 million ounces of gold and 1 million tons of copper. Roughly 770,000 ounces of gold production is our guidance for 2024, and that's at a very low cost of $1,370 an ounce. I think you heard yesterday that the average AIC, all-in sustaining cost, is $1,300 an ounce globally. Ours is $1,370 Australian. So a very low cost, and that's something that we've really worked on hard. We are in a cyclical business. The gold price is likely to go up, but it can go down, and you definitely want to be able to have what Warren Buffett aptly describes as a moat around your business, and that's what we've tried to build. We're very pleased to say that we've paid 21 consecutive dividends. We do believe that whilst it is important to invest shareholders' funds appropriately and prudently, you really do need to provide a return to shareholders as well. This is a very profitable business. Yeah, last year, in a difficult year for us, we made a 39% EBITDA margin. We should have made 45% if Ernest Henry hadn't been out. So 45% is really good. I have a friend in the retail business that says his margin is 12%, and he's in a successful business. So the real challenge for gold companies is, how do you spend that margin? How do you make sure that you're actually going to deliver superior returns to shareholders going forward? Sometimes the best way to do that is to give the money back to shareholders. There's an assumption that seems to be inherent in the gold industry that we can spend the money better than you can as investors. I think that needs to be tested. The reality is also that this is a business that requires a lot of money. I saw a lot of presentations yesterday and this morning. Small companies trying their best with a lot of perspiration, a lot of inspiration, a lot of hope, and a lot of energy, trying to get to the next big discovery. But it's hard. It takes a lot of money. It takes a lot of luck. We spent almost $20 million on the feasibility study on the Mungari, on our Mungari plant expansion, which I'll talk about a little bit later. So it's a business where you need to get to scale. We think kind of 770,000 ounces, up to 8 assets is the right number. We've got 5 at the moment. You don't want to be dependent on capital markets to fund your growth. You don't want to be too big that a discovery doesn't make any difference to your shareholder value. So where is that Goldilocks spot? We think it's kind of up to 8 assets. We think, given the geopolitical risk that is rising, we think being in tier 1 jurisdictions like Australia and Canada is really important, and investors will start to recognize and reward that more as this tension rises. We've been willing to sell assets as well as acquire assets. We always look at it through the lens of, how are we going to improve the quality of our portfolio, and is it going to be accretive to shareholders? And if it meets those 2 hurdles, then we're potential buyers of an asset. So let's just look at the journey of our portfolio and our business. This is quite a busy chart, but on the x-axis, on the bottom axis, you see the mine life. On the y-axis, you see the annual rate of production. On the bubble size, you see the rate of return on investment. And then the color, which we'll describe in a few minutes, shows you how much we've actually paid back of the capital that we've spent. So these are the assets in our portfolio at the moment. This is at the time when they were acquired. So you can see, and remember, this is the challenging thing about the gold industry. Every year in which you own these assets, if you're not at least discovering what you have mined, you're moving those gray bubbles back towards the y-axis, and you're depleting your business. So the challenge in our business is not only finding the ounces that you've mined, but actually adding to that, because then you're really adding value. So let's have a look at them. So Mungari had a mine life when we bought it in 2015 of 7 years. It should have been really almost depleted today. So where is it today? It's now got a mineral resource of 5.3 million ounces, 1.2 million ounces in reserves. We're committing $250 million to a plant expansion to build it up to 4.2 million tons per annum, and that will reduce our all-in sustaining costs from about $2,000 an ounce to $1,750 at this asset, and it's got a 15-year plus mine life. That is really the way you can add value in the sector. You mine the ounces that are there profitably, and you discover more ounces. Let's have a look at what I think has been our best acquisition to date, because hopefully there'll be more like this going forward. But Ernest Henry, we acquired at what was described as an economic interest in 2016 from Glencore. That gave us access to all the gold and 30% of the copper. In 2021, late 2021, Glencore decided to sell us the balance of that asset. We bought it. We've spent $1.8 billion in totality. To date, that asset has now got a 17-year mine life. It should have been finishing off production in the next couple of years. Now it's got a 17-year mine life. It's actually repaid, this quarter it will have repaid that full $1.8 billion, and it's got a 17-year mine life ahead of it. Another favourite of mine was Cow, because Barrick was exiting Australia. We bought that in 2015. It was probably our first really transformational transaction. It had an 8-year mine life when we bought it. Barrick sold it to us for $750 million. That was bigger than our market capitalization at the time. But we knew we needed assets of this type of quality. It was going to process gold, mine gold till 2020, and then process low-grade stockpiles till 2024 under Barrick's life of mine plan. Today, that asset now has 8.8 million ounces in resource, 4.3 million ounces in reserve. We have fully repaid all of our investment in that asset. That includes the underground development that we have just commissioned. It will be producing 320,000 ounces this year. And it's got a 17-year plus mine life with lots of exploration upside. So again, a good indication to me of how value is really created in this sector. Red Lake, as many of you who followed the company will know, that has been a challenging asset. We're about 3 years into this journey. It hasn't been easy. It hasn't repaid its capital. It does have a long mine life, and it's that long mine life and that 12 million ounces of gold that makes me believe that the effort is worth the reward. It is going to be tough. We're getting there, but it's important that we stay the course and we deliver at Red Lake. The jury is still out. We are confident of it, but again, it's the fact that there is such a large mineral inventory and such high geological upside that I think we've got to persevere and we've got to continue on that journey. And I'm confident that Red Lake will deliver value in due course. Here's one that has really I think surprise people, because it's really about thinking differently, which is something we pride ourselves on at Evolution. Mount Rawdon, it was an asset that started with an 8-year mine life in 1990. Nick Giorgetta of Equigold started it. He did a great job in building it very cheaply. It's going to have operated for 25 years. It's fully repaid all of our investment, 100%, and we're going to turn that into a very significant pumped hydro asset, which I'm confident will be very, very valuable to shareholders in due course. We're advancing the feasibility study. It has the potential to power 2 million homes in Brisbane. It will be 2 gigawatts for 10 hours. And I think it's a unique way of showcasing how the mining industry can really add value in a very different way to what the normal headlines in newspapers are. So I think a really great opportunity to showcase the industry and add value to shareholders. And the great thing for shareholders is really that it doesn't have any value in our share price at the moment. It is a free option to them. So that's our portfolio at the moment. Long life assets, a concentrated, high quality portfolio, 1,370 Australian dollars an ounce, very low cost and high margin assets. We were going to talk about renewables. I'll skip through this quickly because I'm running out of time. But it is a real opportunity. I think one of the challenges that Australia faces is we have these political targets that are very ambitious. The reality is that there is very little way of delivering on those targets without a huge amount of money being spent between now and 2030 and beyond. But I think the amount of money that is required, the amount of effort to rewire the nation effectively, yes, there is a $20 billion fund, but the difficulty of rewiring the nation and changing a grid from a highly concentrated coal-fired portfolio into a renewable grid is little understood by the politicians who are putting out these targets. So, we are at the point where we are getting close to completing the feasibility study, and we're talking to people about how to monetize that for our shareholders. I think that's a late 2024 calendar year thing for us. But the more I've got interested in this area and the more I've got engaged, the more valuable and strategic I think this asset is. We're at an interesting point as a company. We've been spending a lot of money on the underground operation at Cow. We bought Ernest Henry, the balance of Ernest Henry in late 2021. We bought the balance of Mungari. We've had a very capital-intensive period. We're moving into a lower capital-intensive period, which frees up cash flow. Our production's going up. Our all-in sustaining cost is going down. Our planning is done at a 2,650 Australian dollar gold price. Obviously, every $300 an ounce, if it's 300 today, which it is, 350, adds about $250 million of additional cash to us. One of the things that I think is often overlooked is that these companies really are about people and culture. And we talk about how do we grow the next generation of leaders in our industry, how do we make our industry more inclusive, more diverse. I think it's about profiling our industry in a different way. It's about attracting graduates into our industry and making it exciting to go into the mining industry. That needs a real change in narrative. That's the reality. The headlines are often negative about our sector, but there are so many very positive things to talk about in the gold industry and the mining industry. I mean, the reality is I arrived in Australia in 1991. Interest rates were 17%. We were in a massive recession. And this country has got rich in the last 30 years, largely because of the mining industry and our connection to China. So, what do we do over here? We're an organization that wants to be different. We have a graduate program. We're not a very, very large organization, but we have a graduate program. It's been amazing. It brings in real talent into our organization, and we've had some amazing successes. Emma Stewart, who's the person who's currently running our open pit mine at Cow, a very large mine in New South Wales, started as a graduate. She's worked at several of our operations. Our geology superintendent at Cow started as a graduate. These are great stories. A metallurgist who was at Cow is currently in our investor relations team and has been somewhat responsible for this presentation. So these are stories which give people opportunity, and I think if you spoke to them, they would say they've got a real energy and excitement about being part of the sector, and it's that generation that we need to be starting to help find their voice, to be articulating that to the broader industry and population. We have an Act Like an Owner program because we actually want every person in our company to feel and act like an owner. We do make every person an owner. We give every employee in our company $1,000 worth of shares every year. Obviously, as you get more senior within the organization, you get more performance rights, but they're connected to performance. So we wanted to skew our reward system towards variable pay. We have a gold program which recognizes and rewards people for coming up with ideas. And it's surprising when you actually go out and you ask people, what could you do to make your job different or better? You get answers. You just have to ask them. So we recognize and reward those people. And a couple of weeks ago, we had a celebration of that where it's quite amazing what ideas get generated from the shop floor. It's fantastic to see, and it energizes the whole organization. So that's where we are as a company. We are challenging, and we don't shy away from that. No one has described me as patient. We want to get things done, but we are a values-driven organization, and there is nothing more important than the safety of our people, the recognition that work needs to be done in a respectful way, but excellence is demanded. And accountability is required. That's how we roll. Happy to take any questions.
I don't know why Tim Whittle is here.
Thank you. Jake, I wonder if you could give us some indication of percentage cost increases due to legislative change over the last few years, which would include decarbonisation.
I don't have the exact numbers. I mean, I can tell you that our power costs have pretty much doubled. And power is about 8% of our costs. So you could say around 4% as a guesstimate would be an increase due to that. Now, I think power costs are going to go up. There's no doubt about that. So I think the conversation just needs to be had. I'm a believer that we do need to invest in renewables. I think we do need to decarbonise, but we have to have the honest conversation about what that cost is going to be. 50% of our costs are labour, so really that's the biggest impact on our business. So the more people we can get into our sector, the more young people who join our sector, the better off we're going to be.
Hi, Jake. In 2033, so which is after 10 years, do you see Evolution Mining becoming more of a green gold producer? So what you've already mentioned, are you planting a seed for that? Thank you.
To me, that's very easy. So just to give you a sense, 70% of our emissions today are Scope 2 emissions, which is effectively as a result of power coming off the grid, which is coal-fired generated. 30% is as a result of diesel, which we use in our pits. So if the government can meet its objectives of delivering clean energy through the grid, 70% of our emissions go. Then you've got OEMs who'll be delivering electric vehicles, and we're already trialing electric vehicles, underground scoops and loaders and things like that. They work well underground. They don't yet have a model for big haul trucks, but they will have them by 2033. So they're going to depend again on being able to be energized through green power off the grid. I don't think that it's up to companies to build their own power stations and power generators to generate power for their operations. I think that's going to be very inefficient. I think we need a national power solution, and if we all agree that that's renewable, which it seems like the population wants, and I agree with, then we need to get going and invest in it. But we will be producing green gold if the government gives us green power.
Oh, hey, Jake. What should we be looking for with Evolution in the next 6 months? What sort of announcements, those sort of things, to follow the company?
Making money. Lots of it. That's what you should look at. I think people are too fixated on how many ounces you produce and worried about that. If you look at quarterly reports, it all leads, and ours does as well, with how many ounces we produced and what cost. People should be looking at how much margin are you actually making, and are you banking the money that you're making? And are you spending it appropriately? Because you have to spend money. It's a depleting business. But are we spending it appropriately and going to make more money off that? The expansion at Mungari, at today's price, will give you a 26% rate of return. It'll give you a 19% rate of return at a $2,400 gold price. The expansion at Ernest Henry and the mine life extension will give you a 26% rate of return. At conservative copper and gold prices. We've earned 25% at that asset on a per annum basis to date. And at today's copper and gold price, it would be 30+%. So those are the sorts of returns that you've got to be looking for. And then you've got to make sure that companies deliver them. We would much prefer to be producing less gold at higher margin than, if we produce 770,000 ounces at $1,370 an ounce, I'd much rather do that than producing 1.5 million ounces at $2,000 an ounce. You'll make the same money.
Jake, it's Headley here. Off to your left, mate. Just
yeah, okay. Hello, Headley.
How you going?
How's the clock?
I'll get to that this afternoon, if you want to stick around. I really enjoyed your slide sequence, so please compliment the graduate metallurgist that's come to that.
It's actually Rocky and Justine as well. They deserve, and Rocky's here.
Well done. That's not the nature of my question, but kudos on the slides. Just you've got 4, maybe 5, one's becoming pumped hydro assets. You talked about up to 8. I'm really interested in growth. It doesn't have to be topical, and it's certainly not a loaded question, but if you have a loaded answer, I'm sure everyone will love it. In terms of growing Evolution and padding out that portfolio to what it could be, and it might not be something that you have to do, but something that you want to do, there's a suite of opportunities. There's always M&A coming in and out of big companies, and then there's a load of stressed juniors which all have projects which are on offer. I just wonder about the skill sets that you feel that are inherent to Evolution, given the history and where it's come from. You know, are you a builder or a buyer, or is it a bit of both?
I think we're a bit of both. I mean, our best opportunities at the moment are organic. I think the reality is that corporate transactions are difficult, and the sellers tend to be happier than the buyers. Certainly in Sino Gold's case, we were happier than Eldorado post that. So I mean, we're always on the lookout. You have to look at it, and we need to keep improving the quality of our portfolio. The fortunate position we've got ourselves in, Headley, is that we've got a good quality portfolio, so we don't want to screw that up by doing something dumb. So how do we get better? If you look at the sort of spectrum of opportunities, yeah, there are those opportunities that may come out of majors. This merger between Newmont and Newcrest may create some opportunity. I think probably the most stressed space in our sector at the moment is the underfunded developer explorer. It's difficult to get access to capital. They are long dated, and there are lots of people kind of competing for that capital. Some of them may have something that's really attractive, and I think where I'd back ourselves is being able to be willing to make a geological call. And if we get that geological call wrong, move away from it. We're doing that in the Murchison area with the Q project. Spend money on it, recognize that you don't have to get married to the project and you don't have to persist with it. Don't fall in love with the project, step away if it's not going to meet our criteria.